Welcome everyone. It's Joe Bloodgood and Nathan Faith again. We're picking up where we last left off on our discussion around healthcare. Specifically, what does it look like for people who are in that gap between retirement and Medicare eligibility? You may recall that there's a dramatic difference depending upon your adjusted gross income in that gap period of time. So today we want to talk about how we control that income to the extent that we can by looking at different types of accounts, how they're taxed, and how we might manage them best in retirement. So Nathan, I know we've shown this in the past, but we try to think of this really in three buckets, and I want to go through each one. Let's start on the left-hand side here with that bucket that says always. Talk a little bit about that if you would.
Yeah, thanks, Joe. So we have certain assets that we control and some that are out of our hands directly that have the most significant tax impact when it comes to managing our income. And so these are the assets that kick out $1 for every dollar that you distribute onto your tax return and affect your health insurance premiums. But you do have some control over the timing of when you withdraw funds from these types of assets. And so let's start with the account that most of us have the majority of our wealth in, which are our IRAs and also 401ks. Those accounts we have the option to draw as much or as little as we want. And during these years where we're managing our health insurance premiums, we want to make sure that we draw only enough to stay within the guardrails of Obamacare. But there are certain types of assets that we may have less control over, specifically pensions. If you're a teacher or you work for the government or qualify for a corporate pension, oftentimes it's difficult to delay that pension's initiation after retirement. Oftentimes it fires up right away. If you can plan around your pension income and limit income that comes out of those other assets in that green bucket, then you have a strong possibility or strong opportunity to stay within the guardrails of Obamacare. And that brings us to Social Security, which is a government pension for all of us. Most Americans claim their Social Security check as soon as they retire. However, most of our clients choose to delay their Social Security payments because they have other assets in these buckets that they can draw from. Not only do they get more out of Social Security, but specifically with planning for this health insurance gap with Obamacare, Social Security can make it next to impossible because every dollar of Social Security income, whether it's taxable or not, counts against your Obamacare subsidies. So we recommend in most cases that folks defer their Social Security benefit until at least age 65 when they can start up Medicare. And then finally, interest. If you have cash in the bank, you're going to earn interest on those dollars, and you really don't have any control on when they land on your tax return. So it's important to know how much cash or bonds you have in those types of accounts so that you can add up how much income is going to come from this green bucket. In many cases, we're not able to pay for all of our living expenses out of the dollars we're drawing from that green bucket, especially if we're trying to stay in the guardrails of Obamacare, which means we have to start considering how to pay for those bills, and we then, planning-wise, move on to this blue bucket, being the accounts that are taxed every single year, such as your brokerage account. In these accounts, you have investments, such as stocks and bonds. Those investments on their own may pay out income that you can't prevent showing up on your tax return, and that income comes in the form of dividends. So it's important that you know how much income you have in a typical year from those dividends. However, you also have income that you can time when it shows up on your tax return based off of when you sell investments in order to raise cash for your living expenses. Paper profit on your stocks, for instance, they've grown in value, but you have not yet sold them, it's critical that you monitor how much the profit will be if you sell a stock to raise cash for expenses and stack that on top of your income from that green bucket to identify where within the Obamacare guardrails that you fall so that you don't overshoot and have a surprise health insurance cost that you didn't expect. Now, with planning, we then move on to bucket number 3, which is our penicillin for planning when it comes to Obamacare, because little or no income from this bucket shows up on your tax return at all, meaning you can pay your bills, but not move the dial when it comes to your health insurance premiums with Obamacare. And there are 5 big types of assets that can help you manage Obamacare very, very effectively. So the first is cash that you have in the bank, whether it be in savings or a checking account or even a CD. Those dollars are yours 100%. And if you need cash for expenses, you can use those funds and it doesn't impact the income on your tax return in Obamacare. Then we move on to investments that are typically held in the blue account that haven't grown in value. So stocks that have actually stayed the same or gone down in value, bonds that you own that tend to stay very steady. Those are the types of investments that you can sell, raise cash, and really have no income show up on your tax return. Third, if you have a life insurance policy that has a cash value component, you can actually borrow money from your life insurance policy to pay for expenses. And any money that you borrow, really from yourself, again, doesn't show up on your tax return because it's a loan to yourself. Fourth, same line of thinking, but you can borrow from your home's equity. So if you have a small mortgage or no mortgage at all, and your home is worth much more than what you owe, you can set up a home equity line of credit with the bank and draw from it as you need to. Now, you'll pay a little bit of interest, but that interest can be well return or the savings that you earn on your health insurance cost through Obamacare and stay within those guardrails. And then finally, the be all end all are your Roth accounts. Your Roth IRAs are tax free accounts for any expense. And if you need to pay your bills through the end of the year and don't want to undo your good planning with Obamacare, you can always draw whatever you need from your Roth accounts and not impact your income whatsoever on your tax returns. So the trick is to know how much you need to spend each year, know what you have as far as resources amongst these 3 buckets, and then to proactively develop a plan on how you're going to keep your income that shows up on your tax return within the guardrails of Obamacare, and then provide yourself some room for error because life happens, and then execute your plan for each year that you have to pay for your own health insurance prior to Medicare.
Thank you, Nate. That was really good information. Hopefully, you recognize that the key to making this work for you is all about knowing first what you'll spend, second, what resources you have, and then finally giving yourself some cushion or some leeway in case of the unexpected, and then finally executing that plan. If you have any questions on any of this, feel free to reach out.